Has your payroll team ever overpaid an employee in California? Maybe it was $200. Maybe it was $500. Maybe an employee was accidentally paid for hours they never worked because a timesheet was entered incorrectly or two payroll systems failed to sync. When you discovered the mistake, what did you do? Did you deduct the amount from the employee's next paycheck? Did you ask the employee to pay the money back? Or did someone in payroll simply say, it was our mistake, let's correct it on the next check? That decision can have consequences far beyond the original overpayment. A $200 payroll error can turn into thousands of dollars in additional exposure. And when the employee's employment ends, the calculation can become even more significant. For example, a $200 discrepancy can potentially lead to a waiting time penalty calculated using the employee's full daily wage for every day the wages remain unpaid up to 30 days. So if the employee earns 120 a day, you are looking at $3,600. The original problem was $200. The resulting exposure can be 18 times that amount. And if the same payroll practice has affected other employees, the numbers can increase very quickly. So today I want to walk you through exactly what happens when a California employer discovers an overpayment, what employers should consider before making a deduction, and why the way the company handles the correction can matter just as much as the original payroll mistake. If you are a business owner, HR professional, payroll manager, or you operate in staffing company, this is one of those issues that can look incredibly routine. Payroll makes an error, someone catches it, the company fixes it, everyone moves on. The problem is that California has a specific rule around employees' wages, deductions, and final pay. That means the question isn't simply whether the company is entitled to recover the money that was mistakenly paid. The question is how the company goes about recovering it. And there is another question that becomes important very quickly. Has this happened before? Because one employee with a $200 discrepancy is one situation. A payroll process that has been making the same deduction from employees for the last 2 years is an entirely different situation. That's where this gets interesting. So let's start with the simplest version of the problem. Imagine you're running a staffing company. You have an employee working at a client site. Everything is going normally. The employee works their scheduled hours, their timesheet goes through the usual process, payroll processes the check. Then, somewhere in that process, something goes wrong. Maybe 8 hours were entered twice. Maybe the employee was paid for hours that were later removed from the timesheet. Maybe the payroll system didn't receive an updated time record. Whatever the reason, the employee receives an extra $200. Nobody intended it to happen. Nobody was trying to give the employee a bonus. It was simply a payroll error. A few weeks later, someone catches it. And this is where the important decision happens. Someone says, let's just take the $200 out of the next paycheck. From a practical perspective, that can sound completely reasonable. The company paid money it didn't owe. The company wants its money back. The employee received more than they were entitled to receive. So why wouldn't the company simply reverse the mistake? Because once money has been paid as wages, an employer's ability to recover that money through a payroll deduction is subject to California's wage deduction rules. That is the point where payroll should stop and evaluate the situation before touching the employee's next paycheck. Now, here's the question I want every payroll professional to ask when an overpayment is discovered. How are we planning to recover this money? That's the question that can completely change the analysis. There is a major difference between identifying an overpayment and automatically deducting that amount from a future paycheck. The company may have a legitimate claim for repayment. The recovery method still matters. And this is where employers sometimes create a second payroll issue while trying to correct the first one. Let's say the employee was accidentally overpaid $200. Payroll discovers it. The next paycheck is $1,800. Payroll deducts $200. The employee receives $1,600. From payroll's perspective, the account is now balanced. However, from a wage law perspective, the company needs to ask whether that deduction was legally permissible because California takes deductions from wages seriously and the circumstances surrounding the deduction matter. So, when an overpayment is discovered, don't make the first question, how quickly can we get our money back? Make the first question, what is the legally appropriate way to correct this? That difference in approach is important. Now, let's move the story forward. The employee continues working, nobody says anything about the $200. A few weeks pass, then the employee's assignment ends. The company processes the final paycheck. The final paycheck contains the wages the employee is owed based on the company's records. Except there is one problem. That $200 was previously deducted from an earlier paycheck. The employee's wages were short by $200. Now we are dealing with final pay. And that's where the financial consequences can change dramatically. California requires final wages to be paid within specific time frames, depending on the circumstances of the separation. When final wages are not timely paid, California's waiting time penalty rules can come into play. Under Labor Code Section 203, the penalty can be measured using the employee's daily wages for each day the wages remain unpaid, subject to the statutory limit. Let's use the same example. The employee was short $200, the employee's daily wage is 120. If the qualifying final pay violation continues for 30 days, the waiting time penalty could reach $3,600. 120 multiplied by 30 days, and remember where this started? A $200 payroll discrepancy. That's why payroll corrections deserve more attention than they sometimes receive. Now imagine that employee was earning $300 per day. 30 days of waiting time penalties could produce a different number. $300 multiplied by 30 days equal to $9,000. And there might also be other layers. The employee may also have a claim for underlying unpaid wages. There may be additional issues depending on the facts. The company therefore needs to look at the entire payroll history rather than treating the situation as a simple $200 accounting adjustment. That's why the moment an overpayment or improper deduction is discovered, it should trigger a review. The objective is to understand exactly what happened. When did it happen? How was the deduction made? Was the employee still employed? Was the employee's final pay affected? And most importantly, has the same thing happened to anyone else? Now let's discuss this question. Has this happened before? Suppose a payroll team tells you, yes, we actually do this whenever an employee is overpaid. Now we are dealing with a completely different risk profile. You may have one employee today. You may have dozens of employees over the last several years. Maybe the same deduction was made every month. Maybe it happened across multiple locations. Maybe different payroll administrators followed the same process because that's simply how they were trained. At that point, the company should stop treating the issue as an individual payroll correction. It becomes a potential payroll practice issue. And that means the company should consider conducting a broader review. Look at the affected employees, look at the relevant pay periods, identify how the deductions were made, determine whether any former employees were affected, review whether any final paychecks were impacted. The objective is to understand the scope before the issue grows further. And this is where California's Private Attorneys General Act, commonly known as PAGA, can become relevant. PAGA allows an eligible employee to pursue certain civil penalties on behalf of themselves and other current or former employees for alleged labor code violations subject to the requirements of the statute. That means a payroll practice affecting one employee can potentially raise a much broader issue. Let's go back to our example. One employee, $200. Now imagine the same payroll deduction affected 50 employees. The original $200 mistake is no longer the entire story. You now have a potential pattern involving multiple employees and multiple pay periods. That's why discovering a payroll problem internally can actually be valuable. It gives the company an opportunity to understand what happened and address the underlying process. The earlier the company identifies a recurring issue, the more options it generally has for managing the situation. So, what should you actually do if your payroll team tells you tomorrow, we accidentally overpaid an employee? First, stop before making a deduction from the employee's next paycheck. If payroll has overpaid an employee, the first thing you should consider is getting a written authorization from the employee to recover that overpayment through a payroll deduction. The authorization should clearly identify the amount being recovered and authorize the deduction from the employee's wages. If you have written authorization, you can proceed with the deduction in accordance with the authorization and applicable wage laws. However, if you don't have that authorization, don't simply take the money out of the employee's next paycheck because the payroll system shows that the employee was overpaid. That's where companies can create a second problem while trying to fix the first one. Now, let's say the deduction has already happened. The company deducted the overpayment without the appropriate authorization, and the issue has now escalated. At that point, the focus should be on correcting the employee's wages. If the employee's paycheck was short because of the improper deduction, the company should pay the amount that was withheld and make sure the employee receives the wages they were actually owed. Then you can separately evaluate how to recover the original overpayment. Depending on the circumstances, that may mean seeking repayment directly from the employee or pursuing a civil claim, including through small claims court where appropriate. The important point is that the employer should not try to solve an unauthorized wage reduction by making another unauthorized reduction. And if the issue has already affected final pay, this is where I would recommend getting legal counsel involved before making the next move. You want to look at the entire sequence. What was originally overpaid? What was subsequently deducted? Was there written authorization? Was the employee's final paycheck affected? And has this happened to anyone else? Those questions can tell you whether you are dealing with one payroll correction or a broader wage and hour issue. Those questions tell you whether you are dealing with one payroll correction or a broader wage and hour issue. So the next time someone in your organization say we accidentally overpaid an employee by $200 or any other amount, don't let the conversation end with okay, just take it out of the next check. Pause and ask how the money is going to be recovered. Ask whether the employee's final wages could be affected. And ask one question that can completely change the scope of the problem. Has this happened to anyone else? Because the $200 overpayment may be the part of the story that gets everyone attention. The payroll process behind it is what you really need to understand. And if you run HR, payroll, or staffing business in California, this is a conversation worth having before the next paycheck goes out. If you found this useful, subscribe. We cover practical employment law issues that businesses deal with every day and break down what the law actually requires when those issues come up. See you in the next one.